The biggest battle in mortgage industry. The battle of FHA versus conventional. Guys, if you haven't followed by now, hit that subscribe or notification button so you're notified every time we go live or post new content. Also, this is an interactive channel, so ask a lot of questions and I will be answering. Okay, let's go after it. So number one, in my guide, you will understand my number one rule is budgeting your mortgage payment. So it's your debt to income ratio. FHA allows 45 over 55, conventional 45 over 50. So you can see FHA is more flexible. So typically if you have a higher amount of debt, FHA might be for you. Conventional, they're not that aggressive when it comes to debt. Let's say you made $10,000 a month. If you have no debt, you can afford a $4,500 mortgage payment max. I don't recommend it to go max on your mortgage payment, right? But if you had to, $4,500. But on FHA, you did have debt. They allow you an extra $1,000. Conventional, only $500. So conventional, a little bit more conservative. Let's talk about credit. With FHA, credit goes down to 580. Conventional, 620. FHA, you want to be in that 620, 640. Conventional, 60, 680. I think more 700. So you can tell FHA, a lot more aggressive. They have looser bankruptcy guidelines. Chapter 711, wait 2 years. Conventional, you got to wait 4 years. Chapter 13, wait 1 year. Chapter 13 means you're reconsolidating your debt. You're still going to pay it. You can buy after 1 year. Conventional, 2 years. Short sales, 3 years, and foreclosure 3 years. Look at conventional, 4 to 7 years. So when it comes to like bankruptcies and credit, seems like FHA is beating conventional all day long. But let's check this out. On an FHA loan, if you want to omit a debt under 10 months old, that debt has to be below 5% of your gross income. So if you make $5,000 a month, that debt that's under 10 months, if it's over 250, you still got to add that debt. Under 250, you can omit it. Look at conventional. If there's less than 10 months left, boom, you can omit it. There's no 5% income rule. Look at omit for cosigner. So on FHA, if you cosign for somebody, like a car, if you are the main person on the car payment, even though they're making the payment and they made 12 months payment, you cannot omit the payment. You got to be the cosigner and not the main. On conventional, it doesn't matter. For a property, they can't tell if you're the main or the co. But for a car, they can tell if you're the main or co. Conventional, a lot more aggressive when it comes to showing proof that someone else made the payment because you cosign. You must meet 12 months checks. Also, IRS. FHA wants proof of 3 months. You made 3 payments before you can account that debt and qualify to buy. Conventional, as long as you have an IRS payment letter, then you can add that payment to DTI. You can qualify to buy. So FHA, you got to wait 3 full payments. That's why FHA, a lot more aggressive when it comes to credit score and bankruptcy, but when it comes to omitting debt or more flexible with monthly liabilities, conventional wins. Now let's talk about income. With income, FHA, you can gross up fixed non-taxable income to 125%, conventional 115%. But with FHA, when you're self-employed, you got to go 2 years tax returns. With conventional, you can go 1 year self-employed. If you've been self-employed for over 5 years, you can go 1 year tax returns. That means if you're a self-employed person, you got to suck it up and file 1 year tax returns, but you can't write off everything. As long as you've been self-employed for over 5 years or the business has been around for 5 years. So it's important that you know that. So when you go conventional or FHA, you know, okay, I am self-employed. Which direction do I want to go in? If you're on non-taxable fixed income, FHA is going to be more aggressive with giving you more income. So those are the requirements. I'm sure there are other income ones. These are the main ones that I see the comparisons. Let's talk about down payment now. FHA, the donor's gift always must be sourced. No matter if you wire it directly to escrow, you got to source it from the donor. On conventional, if you do gift funds, if you wire the funds directly to escrow, your donor does not have to show any bank statement. There's no sourcing with conventional. FHA, you got to source it no matter what. But on conventional, if you wire it to whoever you're gifting it to and they wire it to escrow, you got to source those. With down payment, FHA, 3.5% down on duplex, triplex, and fourplex. Pound for pound, they're going to be conventional. If you go owner-occupied conventional, you got to go 15% down to 25% down, right, for a triplex or fourplex. With FHA, the donor can cover the down payment, closing costs, and pay off the buyer's debt. On conventional, you can only cover the down payment and closing costs. For owner-occupied, for investment, completely different game. Next one, private mortgage insurance. FHA, there's upfront MI, monthly, 1.75. Right now, if you're looking at this, November 2021. Monthly MI, doesn't matter where your credit is, it's going to be 0.85. If you do less than 5% down, 0.80 at 5% down. Unless you put 10% down, the PMI will fall off. On conventional, the PMI is flexible. It's cheaper when you have better credit. That's why I recommend if you have above a 700 credit score, the PMI is cheaper on conventional than it is on FHA. And the conventional PMI, it's not permanent. it will fall off without refinancing. So you don't have to eat up more in your equity to refinance from FHA to conventional. Conventional, the thing will fall off in time. Occupancy, FHA, owner occupied. Conventional, owner occupied, vacation homes, investment homes, a lot more diversity with conventional. Let's talk about some negatives here. With an FHA loan, you got to run the spouse's credit. So if even if your spouse is not going on the loan, you got to run this credit in community states. Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin. Another negative thing about FHA, oh, I want to buy my next house with a minimal down of 3.5. There's a 100-mile rule. So if you have a house and you want to vacate it to buy your other house with an FHA loan, if the house is within 100 miles of your current home, you cannot use rental income to help you qualify because they're of the 100-mile rule. Also, FHA has a self-sufficient rule when it comes to triplex and fourplex. You run into this problem in California all the time. You don't run to it on the East Coast. You don't run to it in the Midwest. So with the self-sufficient rule, 75% of the gross rent of all the units has to be more than your mortgage payment. That doesn't happen when you look at $1 million, $1.2, $1.5 million 4-unit in California. It all depends. Maybe you might get away with it in Fresno, but you're not going to get away with it in San Diego, LA, or Orange County, or San Bernardino, or Riverside. Typically, if the units, the triplex or 4-unit is over $550, $600, it won't rent positive. Well, rents have gone up, but even rates are climbing up as well, and per loan amounts. Definitely make sure you follow that self-sufficient rule when you're buying triplex or fourplex. People I see go to escrow and they realize, oh, the self-sufficient rule just knocked them on their butt. Conventional typically have higher rates than FHA, VA, or USDA. So those are the negatives. So that right there, my friends, is the big battle between FHA and conventional. It all depends on what you fall under. Each program has its little niche to help you qualify for more home or even qualify at all, or it's a better situation for you. If you have more questions regarding should you go FH or conventional, always give us a call or DM us or text us 714-790-9697. If you found this information valuable, do me a huge favor, save this video, share this video, and like it. If you're not following us by now, please hit that subscribe or notification button. And we want to end all our episodes with our attitude is gratitude. You know, without you, there would be no us. So thank you guys so much and enjoy the night.